Due diligence can make or break a multifamily deal. This is part 2 of a 2-part series on what we do once we have an agreement of purchase and sale for due diligence. And so this is going to be all about the financial and lease audit that we actually jump into to ensure that the property is actually performing the way that it was advertised. John, it's great to be here with you.
Yeah, great to be here, Mark. It's funny, at the beginning of part 1, and by the way, it wasn't planned to be a multi-part series, but you even said this might be a 60-minute talk. So we made a game time decision to break it into 2 parts. But it's really, this is the most important part of the process, right? Like if you don't get this stuff right, you may find yourself with a loser at the end of the ownership period. So I'm excited to dive back in and kind of get into that second part, that lease and financial audit.
Yeah, for sure. And this is where having experience of what to look for, and we'll just say what the numbers and the data is saying and what it's perhaps not saying as well. What I mean by not saying, it's like, what are they not providing us that maybe an inexperienced operator would just overlook? And so having that experience, John, going back to that, is like so critical. And I know we've sold thousands and thousands of properties, but these larger multifamily deals, having people on your payroll, the partners on your payroll that have the experience, like 20 years plus experience going through big assets, small assets, and, these types of properties, and seeing the good, bad, and the ugly through the years is something that's worth its weight in gold. Georgia, she'll just say, she'll look at it within 3 seconds, like it's missing this, this, and this. And she's just got a real, trained eye on that. And so that's really now, it's kind of like, Georgia's a little bit like, at home, John, my wife, Joanna, she's been like polishing me and kind of, let me know, it's like, you could do this a little better or that. And I know with Georgia, when we look at like financials and deals, even Joe, for that matter, with his vast experience, he's like, well, here's another way to look at it. And it's just like, oh, that's been great. So since they've come on the team, based on our experience, John, like we have allotted that, but within that short window of a couple of years, like that's been massive. And, we're just seeing it in the quality of the deals and actually the results for our investors.
Yeah, absolutely. Georgia, within you said it, like a few seconds can look at a financial statement and notice an anomaly, like maybe a utility that's lower than it should be based on unit count. And so every market's different, right? And so there's nuance there. But, we touched on this on previous podcasts, but like on the most recent acquisition, the payroll, right? I mean, it's just an immediate red flag because, the unit count, there's sort of like what you should be paying per unit for property management. And it was hundreds of thousands of dollars. And we shared the story. There was families involved and, some generous income going to a daughter there. But that ability to move quickly and not miss those important details at the same time is what the value you get when you hire experienced professionals. We've met many operators and more often than not, I mean, and partly because we try to associate ourselves with winners, right? We're dealing with other operators that are vastly, experienced and know what they're doing. But we've come across a few where, the asset manager came from like the tech world or something. And you're like, that's not necessarily a problem. But for me personally, I'd rather go hire the person with 20 years experience versus trying to teach somebody the learning curve of this new business. And so, it's for us, we're looking for multipliers, right? We always talk about that. Somebody who multiplies our results, not just adds to the results, right? And that's Georgia, that's Joe. So, when it comes to this financial and sort of like lease audit, it's a lot. You're buying 100+ unit building. So each lease file could have 30, 40 more pages that you have to go through. The lease, the financials, the work history, the payment history, lease violations, et cetera. So it's a lot. So you have to have that ability to slow down and get into the weeds and the details, but then also not lose sight of the big picture. So those are rare finds, right? And it takes a lot of time. I mean, with Georgia, that wasn't an easy hiring process. Let's just say I talked to hundreds of people to find Georgia.
Yeah. Diamond in the rough there.
That's right.
And so we didn't mention on the last conversation, John, but a property condition report can be over 1,000 pages. That's like the physical property, the condition report. And so the reality with the financials, you can imagine you have hundreds of units. It's like, it's in depth. So jumping in, the very first thing we're looking for is, can the residents, we'll just say, can they afford to live there? To say it very succinctly. Are they qualified? And did the previous owner just stick residents in that just maybe weren't qualified for the amount of rent? And so the big thing that we look to do is, once we go through our 28-day full out transformation, where we're going and we're adding a lot of value, our goal is to actually bring rents to market value. And so if we do that and the existing residents can't afford it based on their income, that's a challenge for us, right? Like we want to know that up front. And so jumping in here, the very first thing we look for is to ensure that the residents are qualified, that they can afford to continue living in the asset. And so for us, what we do is the very first 28 days, we're going in, we're adding massive value through our 28-day full out transformation. And so we add a lot of value, but we want to bring those rents up to market value. And so if the existing residents, if their income just won't qualify for that higher rent, that's a red flag for us, right? And so we like that income to rent ratio being under 35%. So say on average, the average income's $100,000. We like the rent after renovated rent. After we go in and renovate and increase, it needs to be lower than 35%. So 35,000 of 100,000 average income. And ideally we want to be at 30% or lower. So that's a real big one there. And I know there's another rule as well, John, like 2.5 times of the monthly rent to income ratio there as well, which represents about 40% of their income. But that's a big one that we look for. Yeah. First off is can the existing residents continue to afford to live there?
Yeah. And so to be clear, we're looking at the area's median and average income. We run that calculation before, but when we're doing the audit, we're looking at the actual residents that live there, right? Just that for that clarity, because that is not a law, in lending. When you're buying a home in the U.S. and, Canada, you could probably speak to better than me, Mark, because I know the mortgage world's a lot different up there, but they have those ratios. So they're not going to approve you for a loan, but an operator that just wants to jam people in. And guess what? It's not uncommon for an operator in preparation to sell. Maybe they have 5 or 10 vacant units and they want the rent roll to look good. So they'll jam some people in there, maybe knowing full well, not necessarily like, trying to put people in that they know aren't going to pay, but they may loosen their standards a little bit to get that revenue up, that income up. So it's a better outcome at sale. And so that's what we're looking for. Was there anything like that? Were they given some under the table concessions, or maybe just concessions that we can see there in the financials? But if we saw a bunch of people at 45, 50% rent to income ratio, that's something we're going to have to pause and think about and make sure that, these residents can continue to pay that rent into the future. Because there was a deal we looked at recently that had leased completely down and then got in trouble when they couldn't renovate fast enough. So they leased up quickly, and we still pursued the deal. We ended up pulling away from it. But, my concern going in is like, are we going to see a lease audit with a bunch of people with jacked up credit and, an inability to pay rent into the future? So it's a critical step. That 2.5 times, I've heard other operators talk about it. I like that 30 to 35% ratio. That's my preference for sure. 40%, you're starting to get into something goes wrong in their life. Largely people are going to pay their rent, but if they can't, right, they can't. And so if a medical issue comes up as an example, right now, unfortunately in the United States, a big major medical issue can bankrupt somebody. And so you just have to be mindful of those ratios. And so for us, it's very important.
Yeah, for sure. And to stack on top of that ratio, John, like these states, they're low state income tax to no state income tax. So it just means that they have more money in their pocket to be able to afford increase in rents. Like it's more likely they're going to afford a rental increase in, say, like Florida than, say, like California. The reason being is like California, there's just more taxes going out the door. So the ratio could be the same, but, their extra income that they have, there's more going towards taxes in some of the, California, New York, for example, right? So that's one thing. Now, when we get the actual leases, so the big thing, there's a few things we look for up front. Number one is, when are all the leases up? So we don't want to see all the leases coming due on a specific month. We like to see it spread out through the year. Can you imagine you have all the leases expiring December, 31st.
Right.
And you got like half of them renew, and all of a sudden you're at 50% vacancy, and then your debt service coverage ratio is out of whack, and like you're at risk of losing the property. So like staggering those renewals all through the year, that's something we want to see. Otherwise there's exposure there, right?
Yeah, that's right. And that's why we shy away from student housing. It's an apartment building, but it's just a different skill set to manage that kind of a property, because that's exactly what happens. Everybody leases, say, in, I guess July, and then they all move out in May. And so there's a lot of money to be made. They can be great deals, but it's just different. And it's like we have to flip our psychology. And so we just say, no, we're not going to do it, because we want to do one thing and one thing really well. But we're looking at that for a variety of reasons, right? Because we want to make sure we don't have some issue in that example where maybe a lot of leases, say 60% or 70%, are all coming due at the same time, and renewals and execution there. But we're also looking just to kind of plan ahead, right? Like, so for example, maybe we see a lease is up in 2 months, but the person has 3 or 4 lease violations. So we're going to clock that. That's a potential renovation, right? We're going to non-renew that resident and renovate that unit. So it's something that we're not just looking a month or two ahead. We're really looking, a year ahead. And then we're starting to really bake out our plan. Not only like, we want to renovate 4 units a month. We're actually identifying the units we're going to renovate throughout the year. And that goes back to pre-ordering supplies and things like that, so we can get ahead. So if we sense, for example, that maybe there's going to be a challenge with attaining a certain light fixture that we like, we're going to go ahead and order those, warehouse them, and have them ready to deploy. So it's about a lot of things, not just, do we have to renew a lot of people at the same time? It's also about planning ahead and thinking about the materials you'll need and all those things as well, right? Yeah.
Yeah. The other item is, does the actual lease match up to what they're actually paying in rent? And so, we say the rent roll coming in, and then we actually go and we match up each lease. Right. And again, it's a lot of monotonous work, but just verifying the details and how tight those leases are. That's another thing that we go ahead and, we make sure to verify that. Otherwise, if you start to see cracks in the organizational structure of it, and they're just, they're not keeping, they're reporting on leases, and that's not the fact. We want to ensure that everything matches up, so that, what they're reporting in income is what we're actually going to get on closing day.
Absolutely. Some operators, I would say the majority are keeping a good eye on things, but you do come across situations where you'd be surprised, where maybe the operator owner doesn't even realize that the on-site property manager, is allowing somebody to pay $100 less a month. Maybe they develop some sort of a friendship or something, and the person comes in with a sob story. And, we have those guarantees that we've touched on for a reason. If somebody can't pay, or they have a unique situation, a major life change, like that they can document, we're going to help them get out of that lease. So it's not about like being cold-hearted, but you have to be pragmatic, right? At the end of the day, we've said this a bunch of times, we're operating a business here, right? Not Faris Capital Partners, but the asset itself is a business. And so we have to treat it like a business, right? And make sure that we're looking after future income and covering ourselves from any potential losses. So, it's tedious, to your point, but it's a necessary step. It's a critical step.
Yeah. And then we're looking at utilities, how that works. Is it, RUBS? So RUBS, you ratio utility billing system. So that basically what that is that and there's 2 cases that you can have when it comes to utilities. The residents can actually pay direct for their utilities, right? Or what you can do is actually you can bill back what the actual is. And so for us, we're actually doing an analysis of how much is actually being charged, and does it actually match up to the utilities that are actually being used as well.
Yeah. And a lot of times it's not a choice to make, because maybe the units aren't individually metered. And you do see that more often with older buildings like 80s, 90s. And so, the RUBS program is not a profit center, but we do typically charge back 85%. So we're looking at, is it individually metered, or is it a RUBS program? But for example, we've seen some deals where they're only charging back 70%. Now, different municipalities have different rules around that, and they sometimes control how much you can charge back. And obviously we have to take into account common areas and, the leasing center, all that. But we like to hit 85%. So you might discover an income opportunity. In other words, when you see maybe they're only charging back 60 or 70%, so we can slightly increase that, capture a little bit more, and that's additional income that adds value to the building.
Yeah, for sure. Some other things we're looking for are all the leases actually signed. And by the way, John, this is actually a big one that I saw, like up in Canada, for example. You sign a lease and it's like almost like it just renews. So if for whatever reason, if you don't want to renew with a resident, it's just like it auto renews. And if you want to not renew that, you don't even have a choice. You'd have to, it's just like it auto renews. Whereas that's one of the reasons why I love investing, down in these red states. So we got, in Florida and the Carolinas and Georgia, and I know there's pockets there as well, but in general, they're great that once the lease is up, like it actually means something. Like, because we still have units up in Ontario, just north of Toronto. And again, we have some, we'll call them legend tenants, where they're paying $1,000 below market rent, and the lease expired years ago, and they didn't re-sign anything. They didn't agree to it, but they're still there. Now we can do our standard 2.5% increases, but that's it. Whereas down here, it's like the lease, when it's coming due, that actually means something. You don't need to renew. So we're looking for signed leases as well for protection.
That's right.
And then we're looking, do the tenants, like we actually check, do any of them have criminal records, right? Are there any special exceptions to the leases? Are a large number of the residents, are they delinquent? So are they behind? Were there credit checks performed on these tenants as well, so that we know, like, okay, they have poor credit or not? And then we want to know too, like, if we'll just say the manager, the on-site leasing agent, for example, is, if they're getting a free unit or not, and if that's included. So we're deep diving, and these are some of the things we're looking for when we're going through the leases and the financial audit.
Yeah, the criminal records, all those things are hugely important. Now, to back up just a little bit, so typically in the United States, it's a notice requirement, right? And so that actually ties back to when are these leases renewing? Because, most cases it's a 30-day notice. But for example, if you miss that deadline, you might now have a tenant on a month-to-month lease. And so it's one of those things you have to be really mindful of. And that's something we look for as well, because just because there's not a signed lease in the file, that means they may be on this month to month. Now, what's great about most of these red states is we give the prescribed, notice, and we can get them out if they're not the right fit for the community. But we saw that in our Charleston portfolio. A lot of folks had just converted to month, and we went in immediately on the day of closing and started getting with these residents and getting new leases signed, just because it's just much better for everybody. It's actually better for the resident as well to have a signed lease. It's like it's just the right thing and the right way to handle your business. So we're very diligent on that, but it just goes back to that's work. And so we're going to have to factor that work in, and we may find that some residents aren't willing to re-sign, and so we might find ourselves with more vacant units than we anticipated. So when we find that, what we actually do is we talk to the broker, who will talk to the seller and the property management team to start working on that before we close. In our experience, most are willing to do that sort of work when you ask for it. And so that's why it's important to catch these things in due diligence, so you don't end up surprised when you close on the deal.
For sure. Yep. So what else are we looking at? We're looking at security deposits there. Are they collected, and how much? Charging late fees, pet fees, all these fees that maybe they're advertising and they're not getting, or maybe we'll just say they are getting it and they're not advertising it, right? And so that's where either way, we want to be able to see what the full story is, so that we know exactly what we're getting into. Because, coming back after and reporting to our investors, oh, sorry, we missed this, is like, you should have known that, right?
Yeah, that's right.
And so the tedious work is what saves you long term. And the beauty of this, John, is that it saves a lot of time doing this up front, because it's got to get done eventually. Sooner or later, you're going to find out the truth.
Yeah.
When you know it all up front, you can actually take informed action, and you can execute, and the numbers, you're able to increase the numbers much faster.
That's right. And, that deep dive, right, it keeps on going. So like the utility bill. So on first glance at the financials, we're looking for anomalies, right? So maybe you see a spike, in a month, or maybe a period of time where all of a sudden, there's a trend with, say, water, and then all of a sudden it's shooting up. So that could be a signal of maybe a possible leak or something of that nature, right? So it just opens the door for more questions to get that deeper understanding, or potentially another inspection is needed. So for example, our Largo deal, we knew the irrigation system wasn't working. That was clear. But it is actually an issue with the well. So it's common for, where possible, to dig a well for your property irrigation, so you're not paying for municipal water, but the well would run dry. So we figured that out and, solve for that in our process. So by seeing some of those issues, right, you just go a little bit of, it's like you have to keep peeling back the onion, right, and trying to figure out what is the root cause there. So the utilities is another component we take an equally aggressive dive into. We'll get into those things here in a minute, right? But that's a big component here as well.
Yeah, so we want to go back 1 to 2 years there to see any trends. So when it comes down to utility, we can actually do a utility audit to be able to dive in deeper if necessary. But we're looking for things like, water spikes. So for example, if 1 or 2 months the water went up and massive amount, and we saw it drop down, we'll actually go to the expense report to be able to see, there was some issues there on the plumbing, which was fixed. And, so that story matched up. So we're basically looking for the story, and we're looking for stories behind the stories to make sure that everything is matching up. And it's kind of, I like puzzles growing up, John, but, it's kind of like a puzzle piece that we're making sure to put together to know the entire story.
And actually getting the bills is important here, because then you have to verify, does the financial statement actually match the bills? Because, they have a great accountant, whatever, but sometimes numbers get transposed, or people kind of put the wrong data in. So, that could impact the value of the deal in the future. So matching everything together, right? It is like putting a puzzle together, truly.
For sure. And so, we're looking for even the utility deposits. These can be substantial. And so we're looking for those. Okay, how much is that? We're reviewing all the contracts with, third parties. Like if you're, say, laundry, you're outsourcing that, and you have, we'll just say, some rentals coming. Okay, I want to be able to review those contracts. Their trash pickup from valet. If you're outsourcing that to a company, we want to be able to look at the contracts, the exterminators, landscaping, Wi-Fi, lawn maintenance, cable. There's income potential in there as well, but we want to be able to see, what is the existing owner, what are they locked into, to be able to see, is this something that we want to, continue? How long did they lock in for, right? What then we'd be bound to, which we got to factor that into our final decision.
That's right. Often those contracts carry over. So if you don't do that audit, you might find yourself stuck with, say, a landscaper that you didn't really want to be stuck with, right? And so, those contracts, reviewing every detail of those contracts is really critical, because, for example, bulk internet, that's a negotiated thing, and we often have to inherit that. And so if we thought we can insert our own and the numbers were a little bit different, we have to make that adjustment on our pro forma and see how that impacts returns before we decide to move forward.
Yeah, for sure. So if you want to add washer and dryers, does the existing laundry contracts allow for that? So say they're all rentals, and it's like, I want to go in and add our own. It's like, oh, we can't do that because we're locked in for 5 years. And so we want to be able to see, can we renegotiate these? And, a lot of cases, we're not talking a couple $100. We're talking tens of thousands of dollars, which that means something, right?
Absolutely. Yeah.
And so and the interesting thing there is, for every dollar of increase net operating income, because this is the income approach, right, is $240 of extra value. So if we can save or find some hidden expenses that we can save on, or there's extra income there that's not being factored in, for every dollar we find, we're increasing the value. We're making $240 in value based on the income approach, right? Mm-hmm. So it's like little hidden, we'll say, candy Easter egg hunt, right? It's like when you find something, it's like, oh, I found a big one here, and if that's $100, oh, I just made $24,000 for the business plan, right, for the overall returns, which helps. So that's kind of, it makes it a little bit more fun when all the tedious work, right?
Yeah. Well, it's a small number examples are illustrative, but it's like, okay, take that to the next thing. If we could save $1,000 a month, we just added $250,000 in value to the property, right? And so it's substantial. And so you have to have that kind of ability to get into those details.
Yeah, for sure. So you can see why it brings excitement to an otherwise very monotonous, process. But it's super rewarding on that. And, I think the next part of this is really important is once you collect all the data to go back and actually look at, okay, were there any red flags, and to actually discuss as a team and, with your wise counsel, is this still the asset that we thought we were actually buying? And so this is where, for a lot of operators, they're so far in at this point. And it's just like, even if there's like something major red flag came up, it's like, we're so far in, just keep going, going. And so we want to go back and reassess and actually say, okay, is the wise decision to move forward or not? And so that takes discernment, and it takes, in some cases, courage, which is not an ideal situation, but if you have to do it, it's, of course, when I say have to do it, in some cases, you might need to actually walk away if the seller's not willing to, take a concession or give a concession on something that was a major part, because just the numbers don't work. And so that's tough to do when you've invested a month into something and, tens of thousands of dollars in all the due diligence work.
Yeah. Earlier on, it was actually in the previous talk, we covered like the pets, right? And then, in this talk, we covered like the pet fees, but that's all how this all kind of ties together, right? Like that reassessment process, because maybe as we do the unit walks and the lease audit, we discover that they're not as diligent about, screening the dogs that come into the property. So, Faris Capital Partners, Faris Residences does have some breed restriction and size restrictions. A lot of buildings do, but you'd be surprised, some don't. And so we're doing the lease audit and we see, okay, no pet fees are being charged. Now we're doing the unit walks and we see there's like some 150-pound dogs running around. And that's going to impact your unit turn cost. So in other words, when that resident moves out, and maybe it's a beautifully renovated unit, but we're going to have to make it ready, that make ready work for that next resident coming in. And if the carpet's shredded, and we didn't anticipate that, right? That's a problem. Or maybe the laminate vinyl tile just gotten shredded, right? So we have to replace some of those boards. So it really is, another part of the process. It's like a whole other factor. And I mentioned this on a previous podcast as well, but that sunk cost fallacy, sometimes when you invest a lot of time, effort, and energy in something, your instincts are just to keep moving forward because, it's more about what you lost, not what you have the potential to gain. And so having the ability to really slow down, and I think that's the value of the power team, once again, that we have, because I would use Madison McCarty, our director of finance, as an example. She is like the absolute loveliest person. We love her. But she's a little bit more skeptical. And so she'll, I don't know, and so, just having that team that's willing to not only speak up, but, provide that candid feedback or be the lone voice of dissent. We ask for that. We invite that. And I remember when I first started, you and I had known each other for 5-6 years before we started, but you did a webinar, and it was the coolest thing because after the webinar, you're asking the team for feedback, but you almost had to pull it out as, I don't know if you remember, but we're like, oh, great. No, BS, tell me what you really thought. Yeah. And I remember one of the team members was like, well, that joke just didn't land, Mark. It actually was kind of awkward. and at first I was like, man, he went in hard. And then you were like, oh, great feedback, take it out. And so one of our fundamentals is we seek feedback. We want to know from the team. So we've empowered the team to speak up. So, you and I are deal makers, and, so it's important for us to have some people around us that go, I know you guys really like it, but, this is not something we're going to be able to overcome, and we need to really think about it. And so, use this time to really engage with the work. It is tedious, to your point, and it can take some time, but in a sense, you have to go back to the pro forma and rework it and just incorporate all that data you brought in. And because, at Faris Capital, we do a lot of pre-work, and I would say it's almost like a whole round of due diligence before we even submit our LOI. We haven't had that issue emerge, but it could. And so you have to be willing to walk away if there's no creative solution or if the deal is fundamentally changed because of some of the discovery. For us, we've talked about reputation many times on this podcast. But, with our investors, right? We have, the way we think about it, we will die if we don't deliver what we promise, right? And so it's something we take very important. So I'd rather call an investor and say, gosh, I hate it, but we discovered some things and this just isn't the right fit for you or for us, versus calling them 4 years later and going, you remember we talked about 20% AAR, it's actually going to be 5, it's much easier to have that first conversation than the second, right?
Yeah. And so if we were to kind of capture what are some maybe character traits or some things to be able to set the stage that are really important when it comes down to due diligence and making that final decision. And so I think being objective with information is really important to be able to make a wise decision, which is one. The other thing that's really important, and I've seen this with other operators, it's being organized, okay, and attention to detail. So this is like a big one. The attention to detail is something it's like, the inspector said it was fine, or he said it was fine. It's like to actually dive in deeper. And if something's not really making sense to you, to be able to get the true story or the story behind the story. And then adding to that is this idea of urgent attention, because you have 30 days there and it's like, it's easy just to say, oh yeah, it's good, move on. Versus like, I'm urgently trying to get to the bottom of the true story to be able to make that wise decision. And so the urgent attention and getting things done quickly without making shortcuts, to me, is something that is so critical, especially on assets like this. Everything is magnified. If you get it right, you can be a real hero to a lot of investors. If you don't get it right, the opposite is true as well, right?
That's right.
So those would be like the big thing when I think about it. And then, of course, experience.
Yeah.
You can't replace that being in certain situations. It's like, if you can have a team going in that is experienced, that have seen, vastly different types of assets and inspections and the good, bad, and the ugly, that gives you such a competitive advantage to be able to, select and make a wise decision at the end of the day.
That's right. And I would only add to that, like, you also have to be a little bit reasonable here as well, because those broker relationships we touched on are so important. They're key to your success in this business. And so, when you underwrite conservatively on the front end and you add a contingency budget for your CapEx, you go in and during due diligence, you find maybe a $25,000 repair or something that you didn't anticipate. In our world, we're not going to go back and retrade on that, right? Just, the deal should have already supported that. Now we might look at the deal and decide, is there somewhere else? Maybe we estimated 50,000 for landscaping, but we can probably get it done for 40. So we're going to make up for it somewhere, but things will come up in due diligence you did not anticipate. And if you go back and beat the broker up and beat the seller up over it, you may have cost yourself future opportunities down the line. So it's being critical. It's all those things you outlined, and but it's also being reasonable and understanding that sometimes things are going to be here, and if your underwriting was done properly on the front end, it should be able to absorb that.
Right.
No problem. Right.
That's so critical, is being conservative at the front end. Going into it, it's like, the end of the day, the numbers still work in a big way. And so, John, from the experience going through, when we're going through a due diligence, we haven't had it yet where it's like, this is a whole lot more. It was like, we've been peeling back. It's like, I was able to save here, I was able to save there. And, that's one of the benefits of having, real, we'll call them rock stars on the team. And so I totally agree with you. You got to be reasonable when something comes up down the road to maintain the relationship. With that being said, the reason you can do that and still protect your investors is that front end work, and being conservative at the front end. So
that's right.
Absolutely. Very good. Yeah. Any last thoughts, John?
No, it's just, if you have any questions on this, maybe you're thinking about buying a single family rental, like, we're here to talk. Like, we obviously want investors in our world, right? But at the same time, we're here to add value. So, you can always come to our website and book a time to talk if you want to learn more about our process or whatever it might be. Once again, we have a very robust checklist. So if you'd like to spend some time with myself or Mark, we'd be happy to do that, walk you through how we execute on a variety of these things. But due diligence is one of the most critical factors. So if you want to talk about that, please feel free to reach out.
Yeah, for sure. And we'll make sure to put our contact information in the notes below, guys. So really appreciate you guys. Thanks for listening. If you enjoyed the show, please subscribe and share with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.